Okay, so a nurse finishes her 14-hour shift, clocks out, and flips on her social media. The first thing she sees is a headline. The stock market hits another record high. Corporate earnings are through the roof. The economy is booming. She thinks about her own paycheck, which buys a lot less than it did 5 years ago. Her rent is up 30%. Groceries are up 22%. But her wages? They've barely budged. And she is not alone. This disconnect is not a glitch in the system. It may be the system working exactly as designed. Before we begin, this video is an educational and analytical discussion of economic structures and corporate power. It reflects my analysis and opinion based on publicly available information and does not promote violence, hate, or extremist ideologies. I am not offering investment, legal, or financial advice here. I am just walking you through how I think through this problem. Since the early 1980s, median wages for typical American workers have been essentially flat when you adjust for inflation. Meanwhile, the stock market has grown by over 1,000%. Not a typo. 1,000%. That is not a small divergence. That is two economic realities splitting apart and heading in opposite directions. Some analysts wave this away and say, well, artificial intelligence is coming, the future is bright, asset prices reflect tomorrow's promise. Others tell a simpler story. The rich are getting richer, buying more assets, driving up prices. But here is what caught my attention. Populist politicians on both the left and right have started converging on a different explanation entirely. They are pointing at giant corporations, Amazon, Google, the usual tech suspects, and saying these companies have rigged the game. Bernie Sanders puts it bluntly. We are seeing sector after sector controlled by a handful of corporations engaging in what looks a lot like price fixing. He calls it a moral crisis. I think it is more than that. I think it is an economic crisis that is hiding in plain sight. But here is where my skepticism kicked in. Does not economics tell us the opposite? Do not we want innovative companies to succeed and inefficient ones to fail? If Amazon and Nvidia are dominating, is that not just the market rewarding excellence? That question sent me down a rabbit hole that lasted weeks. I read through academic papers, corporate filings, historical antitrust cases, and eventually reached out to an expert who has spent his career studying market power, Professor Yang Ika, author of The Profit Paradox. What he told me fundamentally changed how I see this entire picture. He said we are witnessing a massive increase in what economists call market power, the dominance of large firms. And this has enormous implications for the entire economy. But here is what gave me hope. He also argued it does not have to be this way. We have already solved this problem in another arena. We know exactly how to keep competition alive. Before we dive deeper into whether giant monopolies are actually destroying our economy and how we might fix it, I need to give you the context I wish I had when I started. How did we even get here? How did a handful of corporations come to dominate everything from how we shop to how we communicate? The answer is not simple, but I have identified 5 distinct shifts that all began around the same moment in history. Understanding these 5 shifts is critical because they explain why firms got bigger, why they got more profitable, and why that combination may be toxic for everyone else. The story really starts in the early 1980s. If you look at profit margins per product, what economists call markups, they were actually lower than they had been in decades. Stock prices, adjusted for inflation, were at historic lows. Then something strange happened. Not only did profits and stock prices recover to previous peaks, they went into absolute stratospheric territory. But why? What changed in 1980 that made big companies not just bigger, but vastly more profitable? I found 2 categories of explanations. First, there are forces that made companies naturally bigger without necessarily making them more profitable. Second, there are forces that allowed those already big companies to entrench their position and extract monopoly profits. This distinction matters enormously because one of these might be inevitable and even beneficial. The other? That is where the danger lives. Let us start with the first category, why firms got bigger. The most obvious culprit is the mass adoption of digital technology. 1980 is really the inflection point where households, firms, and society as a whole began integrating computers into daily life. The 90s brought the World Wide Web. The 2000s gave us mobile technology. The 2010s introduced big data. And now the 2020s are being reshaped by artificial intelligence. This is not a single event. It is a continuous evolution. Here's the crucial insight about digital technology that took me a while to fully grasp. These innovations have what economists call economies of scale. The more products you make, the cheaper each one becomes to produce. The key driver is something called fixed costs. Let me explain this with an example that clicked for me. Think about the airline industry. To build a single airplane, you need materials and labor, variable costs that scale with each unit. But before you can even start, you need years of research, testing, and a massive factory. Those are fixed costs. They do not change whether you build one plane or 1,000. If you only build one plane, you have to recoup all those fixed costs from that single sale. Build two planes, and you spread those fixed costs across both units. Build 1,000, and the fixed cost per plane becomes tiny. This is why industries with high fixed costs naturally tend toward consolidation. They have massive barriers to entry. Now contrast that with a handcrafted furniture workshop. Each chair requires skilled labor from start to finish, high variable costs. The fixed costs, a few tools, a small workspace, are relatively low. A craftsman can enter the market easily and compete. This is why post-war America had hundreds of furniture makers, but only a couple of airplane manufacturers per country. Boeing and Douglas in the US, Fokker in the Netherlands, Saud Aviation in France, de Havilland in the UK. But here is what changed. Today, even the airline industry, once the poster child for healthy oligopoly, has become a global duopoly dominated by Boeing and Airbus. What happened? Digital technology supercharged economies of scale in ways we did not anticipate. Every wave of innovation, computers, better communications, the internet, big data, raised fixed costs while making those costs more efficient to bear. Boeing could now coordinate global supply chains with precision. Amazon could manage inventory across continents. Zara could track fashion trends in real time and adjust production instantly. The digital revolution meant fixed costs became a larger share of total costs, and the firms that could bear those costs grew ever larger. For brand new industries created by the digital age, operating systems, social networks, the variable cost of adding one more user is virtually zero. Naturally, these industries consolidated into giants almost overnight. The second major shift was hyperglobalization. This IMF graph I came across tells a stark story. Starting in 1980, the global economy integrated at a pace never seen before. Suddenly, markets were not national. They were planetary. An airliner manufacturer was no longer limited by domestic demand. To compete, you had to scale globally. This pressure forced consolidation across every sector. So digital technology and globalization explain why firms got bigger, but they do not explain why those firms became so much more profitable. In a competitive market, high profits should attract competitors who drive prices down. That is economics 101. As Alan Greenspan argued back in the 60s, American financial markets are so deep that sustained monopolies should be impossible. Yet that is exactly what we have seen. Profits have exploded, stock valuations have soared, but the number of startups challenging these giants has collapsed. The competition story broke down completely. Here's my analysis of why that happened. I found three distinct mechanisms, and I want to walk through each one because they are not obvious. First, the digital economy created a new form of economies of scale, network externalities. This is subtle but devastating for competition. I use a social network because everyone I know is on that network. The value comes from the network itself, not the app. There is no point in me switching to a superior platform if I am the only one there. This dynamic creates what is called a lock-in effect. It becomes nearly impossible for challengers to break through, even if they build a better product. Instagram, Tinder, Facebook. These platforms can extract higher prices or, more commonly, sell your data to advertisers because you cannot leave without abandoning your entire social graph. The second mechanism is more direct. When competitors do emerge, dominant firms simply buy them. Facebook bought Instagram. Match Group bought Tinder and Hinge. This is not just tech. In pharmaceuticals, research shows that when a big company acquires a smaller firm, the acquired drug projects often vanish if they compete with the buyer's existing products. Monopolies claim these mergers create synergies. Sometimes that is true, but let us be honest, often it is about eliminating threats before they mature. Warren Buffett, the most successful investor of our time, openly admits he looks for companies with what he calls a moat. He wants a valuable castle protected from competition. That is great for shareholders. It is terrible for everyone else. The third mechanism is regulatory. In the 1950s, 60s, and early 70s, antitrust enforcement was aggressive. Courts blocked mergers and broke up monopolies. But starting in the late 70s and accelerating through the 80s, a new intellectual consensus took hold. Economists like Greenspan successfully argued that markets were self-correcting. If a company was big and profitable, that was proof of efficiency, not market power. Antitrust laws were loosened. Enforcement collapsed. The result? Firms could engage in anti-competitive behavior with little fear of consequence. So we can now answer what happened in 1980. It was not one thing, it was 5 reinforcing shifts. Digital technology, globalization, network effects, predatory mergers, and regulatory capture. These combined to make firms bigger and more profitable simultaneously, and that combination is what broke the link between productivity and wages. Look, when you are spending hours researching how corporate power structures squeeze the average person, the last thing you want to do is spend another hour meal prepping for a week that is already too full. That is why I started using Mom's Meals. They deliver chef-prepared, ready-to-eat meals straight to your door. The options are genuinely flexible. Keto-friendly meals, diabetic-friendly options, high protein, low cholesterol, halal, vegetarian meals, and honestly so much more. Everything is designed for convenience and nutrition when your schedule is packed. Prices start from just $7.99 per meal. I have put the link in the description, and you can get 50% off your first order if you want to try it. It is one less thing to worry about when you are trying to make sense of an economy that feels stacked against you. Now, here is the uncomfortable question we have to grapple with. Are these giant monopolies actually making our economy worse? On the surface, it seems absurd. Google, Microsoft, Nvidia. These are among the most innovative companies in human history. They create products we use every day. They push technological boundaries. How could that be bad? This is where I had to confront a counter-argument head-on because it is powerful and persuasive. The efficiency defense goes like this. In a global economy, you need scale to compete. These companies are profitable because they are efficient. They invest billions in research and development. They deliver value to consumers. If you break them up, you risk losing those economies of scale. You risk ceding ground to Chinese competitors who are not bound by the same rules. You risk killing the goose that lays the golden eggs of American innovation. This is the argument you hear in think tanks, on earnings calls, in congressional testimony. And it is not wrong on the facts. These companies are efficient. They do invest heavily. They have created enormous value. But here's my evaluation of that argument, and this is where I think the mainstream narrative misses the deeper point. Efficiency at the firm level does not equal economic health at the societal level. In fact, under certain conditions, they are in direct conflict. When I read Professor Eek's research, this distinction became crystal clear. A monopoly can be incredibly efficient at producing its product while simultaneously destroying the competitive dynamics that make the entire economy innovative, dynamic, and fair. The innovation that matters for long-term prosperity is not just what happens inside Google's research labs. It is what happens when 100 startups collectively experiment with new ideas, fail fast, and challenge incumbents. The data is striking. When you compare one large firm to 100 smaller firms of equivalent total size, those 100 startups jointly produce more innovation. They file more patents. They explore more dead ends that lead to breakthroughs. This is not theoretical. We are seeing innovation decline as firm size increases. That is the paradox. The most innovative firms may be reducing total innovation in the economy. Now let us look at the 4 ways monopolies damage the economy. And I want to frame these not as a chain of causation that I have traced through the data. First, monopolies charge higher prices. This is obvious, but the mechanism is subtle. They do not just set prices high from day one. They use dynamic pricing, data surveillance, and subtle quality degradation to extract maximum revenue without triggering consumer rebellion. When you have no alternative, you tolerate what you would never accept in a competitive market. Second, higher prices mean lower demand. Lower demand means less production. Less production means fewer workers hired. When this pattern repeats across sector after sector, total demand for labor falls. Worker bargaining power collapses. This explains the broken link between productivity and wages. For decades, when firms became more efficient, workers shared in the gains. Since the 80s, that link has been severed. Productivity has soared. Median wages have stagnated. The profits went somewhere, but not to the people doing the work. Third, monopolies explode wage inequality. As dominant firms expand, they compete viciously for what economists call superstars. In a monopoly context, a marginally better AI engineer or a slightly more effective CEO can translate into billions in additional profits. The return on talent is massive, so Facebook and X pay millions to top engineers. CEOs see their compensation skyrocket. But the median worker, their wages are suppressed by the same forces that lift the superstars. The income distribution stretches at both ends. Fourth, and this is the one that shook my assumptions, monopolies reduce innovation. Not because they stop innovating internally, but because they kill the ecosystem of external challengers. When a startup cannot compete on a level playing field, when it knows it will either be acquired and killed or crushed by predatory pricing, the incentive to challenge the incumbent disappears. This is the quiet tragedy of monopoly. No one sees the innovations that never happen, the companies that never get founded, the breakthroughs we never realized we missed. When you add these four effects together, higher prices, lower median wages, soaring inequality, and suppressed innovation, you get an economy that feels fundamentally broken for most people, even as it produces record-breaking stock returns for a few. The question then becomes, what do we do about this? According to my research, the solution is not mysterious. We have already invented it. We use it in sports. The concept is a level playing field with clear rules and a referee. Think about professional sports. The NFL does not let the best team buy all the best players. They have a salary cap. They have draft picks that favor the worst teams. They have referees enforcing clear rules. The result is competitive balance. Without these rules, the league would collapse into boredom. The same logic applies to markets. In practice, this means reviving the antitrust enforcement of the 50s, 60s, and 70s. But we cannot just copy-paste old rules. Technology has changed. That brings me to a concept I found in my research that I think is genuinely promising: interoperability. Interoperability means separating the network from the operator. Let me make this concrete with a messaging app. Right now, if you are on WhatsApp, you cannot message someone on Telegram. Why? Because WhatsApp owns the network, your contact list, your social graph, and the operation, the app interface, the features. If regulators forced WhatsApp to open its network, to allow Signal and Telegram messages to reach WhatsApp users, suddenly you would have real competition. WhatsApp would have to compete on features, privacy, and user experience rather than relying on lock-in. Europe is already experimenting with this. High-speed rail networks are being forced to open their tracks to competing operators. A Spanish train company can now run on French rail lines. The network, the physical track, is separate from the operator. Research shows this has cut ticket prices by 28% in some markets. More competition, lower prices, more hiring. It works. Could this work in tech? Could we force social media platforms to share messaging protocols? Could we require cloud providers to let you export your data seamlessly? These are the questions I am wrestling with. The technical challenges are real, but not insurmountable. The political challenges, though, are massive. I think we are at a rare moment of bipartisan alignment on this issue. Senators on the left and right are both pounding the table about corporate power, but alignment on the problem does not equal alignment on the solution. The left wants structural separation and aggressive trust busting. The right wants lighter touch regulation, but is angry about censorship and ideological capture by big tech. Bridging that gap will require political creativity. Moreover, I see two massive variables that could change everything. First, artificial intelligence is creating a new wave of economies of scale that could make today's monopolies look small. The fixed costs for training frontier AI models are approaching $1 billion. Only a handful of firms can afford that. Without intervention, we risk consolidating power in ways that make correction impossible. Second, geopolitical competition, especially with China, creates a new argument for national champions. The thinking goes, we need big firms to compete with Chinese state-backed giants. Break them up, and we lose the tech race. I find this argument seductive but dangerous. It conflanes corporate scale with national strength. A competitive ecosystem of American firms might be more resilient than one or two monopolies vulnerable to single points of failure. The divergence between wages and stock prices is not a bug. It is a feature of an economy where market power has been allowed to concentrate without countervailing force. The 5 shifts: digital scale, globalization, network lock-in, predatory mergers, and regulatory capture, created a self-reinforcing cycle. Breaking that cycle will require more than outrage. It will require institutional redesign. I would also like to know what you think. Can we make American markets competitive again? Or is that a naive pipe dream given how much influence these corporations wield over politics? Drop your thoughts in the comments. If you found this analysis useful, do not forget to subscribe, like, share, and hit the notification bell. Thanks for watching. See you in the next one.